Hello guys. So in this video, we are going to discuss about the financial forecasting that uh, what is the concept of this financial forecasting and what all the methods are there to calculate or to just forecast our finance. Okay. So very first, what is this financial forecasting? So basically, if we are forecasting regarding the finance in future based on the historical performance of a company, okay, so that is known as the financial forecasting. Okay, if we are predicting about the future by just seeing what all the performances were there in a past. Okay, so that is known as the financial forecasting. That financial forecasting could be for a revenue, that in future what the revenue we are going to get. Okay, so basically we used to estimate our future revenue by just seeing what all the performances were there regarding the revenue in the past. Okay, just say example that we wanted to forecast about the sales, that what will be the sale in a future. Okay, what will be the quantity of that sale, number of sale there in a future. So by just keeping the past performance of that sale as a base, we can predict or we can forecast that sales. Okay, so that will be your sale forecasting regarding the sales. Now next is that could be your expenses also, that what is the what all the expenses are there in a future. Accordingly we are going to check that in present or in future what we are getting. Just a minute. Yes. So regarding any of the thing, if we wanted to forecast, so if we are predicting that any of the future values like your expense, your cash inflows, your revenue, your sales, by keeping in mind the past performance, so that will be your financial forecasting. Now, as we have to forecast, so we should have the methods through which we can forecast. By just seeing that we cannot forecast, where there should be some techniques through which we can forecast the same. So if we are discussing here about the financial forecasting, so that is subdivided into quantitative techniques and the qualitative techniques. So in quantitative techniques, basically if we are going to forecast regarding the numbers, so in that we used to calculate or we used to have a quantitative techniques. Okay, so in that quantitative technique, very first is our percentage of sales. Okay, now here we will check only very simple ways there, that we will calculate that in future what was the percentage of sales from the past year. In present year, what was the total percentage changes in the same. Accordingly we will calculate for the future, that if in present time this is the change in the percentage, so in future there would be a this same. Okay, for example, in present in past year there was a sale of 80%. Okay, now in present year there is a sale of there is a change in sale of 20%. Okay, accordingly we will predict that in future we are going to increase our sale by about 25% or 30%. Okay, next is a straight line method. Okay, in this straight line method, basically from the past performances we only see what is the trend of that changes. Okay, regarding the expense, regarding the revenue, whatever, what is the trend there of that change. Accordingly we use to predict for a future. Okay, then next is your moving average. We, by just having 4 or 5 years of data, we used to calculate the average. Okay, that average, by calculating that average also we used to predict that in future this could be our financial forecast. Okay, simple linear regression. Linear regression here means there will be a one dependent variable and there would be a one independent variable. Okay, that dependent variable could be any of the factors which going to impact by the independent variable. Okay, that independent variable could be your financial performance. Okay, like what is your financial performance? Accordingly, your dependent variables are going to impact. Okay, like your sales, like your expenses of that, the revenue, anything. Okay. In a multiple linear regression is also a same, only a expansion or the uh, uh, the expansion of the simple linear regression only, where you will have a more and more of dependent variable as compared to our independent variables. Okay. Now, if we talk about the qualitative techniques, in that qualitative techniques, you have a Delphi method, okay, where you used to predict about the uh, company by just hiring any expert, okay, where you have some sort of questions that in that questionnaire, according to that questionnaire, you have to submit to that expert to just have a forecast regarding your finances. Okay. Now, according to that set of questions, they used to do the research on that and they give you the financial forecasting of the same. Okay. So that is a Delphi map. Now, if we talk about the market research, so this is in-house only, where the experts of the company only are doing the research regarding the market, that in market, what all the changes are going to happen, okay? Whether it is your external changes or whether it is your internal changes. What all the changes are there which is going to happen by just having a look on the environment of the market. Okay. So if we used to do, so we will call it as a market research. So basically in this financial forecasting, these all are the techniques through which we used to do the forecasting or the predictions. Okay. So here we have finished our the concept of the financial forecasting. Have a nice day.